Good afternoon, Mr. and Mrs. Brown. It is so nice to meet with you guys again. I am David Dry, your Executive Wealth Advisor here at Dry Wealth Management and Tax Advice LLP. And today we will be walking through your executive summary based on your comprehensive financial plan. We will start off with your current financial goals, followed by an analysis of your cash management, your education planning, your risk management, your investment planning, your retirement planning, tax planning, and estate planning, and then finally bringing all of those recommendations together into a revised financial goals list. Let's get into it. The first topic we would like to discuss is your financial goals, both currently and for in retirement. These goals are separated into three primary categories: needs, wants, and wishes. These are based on the priority ranking you provided us in the Retirement Lifestyle Workbook. Needs are classified as a ranking between 8 and 10, wants fall between 4 and 7, and wishes fall between 1 and 3. It's important to note that your retirement living expenses and your healthcare out-of-pocket cost while in retirement are based on Money Guide Pro's program estimate. These values fall at $142,000 for retirement living expenses and $11,000 for healthcare out-of-pocket cost in retirement. And these are automatically set at a priority ranking of 10. Next, we have wedding funds for both Charles and Tammy. These both are set at $15,000 and have a ranking of 9. Following that, we have college for Tammy at Baylor, funded at 80%. This is currently valued at $75,000 based on the projected cost of the university in 2027, and that has a priority ranking of 8. Following that, you have traveling in retirement and anniversary celebrations in retirement at $25,000 and $10,500, repeating annually, respectively, with rankings of 8 as well. Then we have Paul's car upgrade at $60,000 every 3 years. And then finally, your retirement home purchase of $900,000 set to occur sometime between now and retirement. That concludes the needs. Now the wants is providing health care for your family, which you project will cost approximately $40,000 each year throughout retirement. Then you have college for your grandchildren, which our program estimate has created a number around $30,000, and that has a ranking of 7. Next, you have paying off the new mortgage for your retirement home with a ranking of 7, and that value is to be determined. And the last one you have is Amy's car upgrade every 4 years, set at $45,000. Finally, we get to your wishes, where you have a bequest for both Charles and Tammy of $250,000 with a ranking of 3, and an end-of-life church gift and end-of-life charitable gift of $500,000 and $150,000 respectively, both with a ranking of 3. Now that we've discussed your current financial goals, we would like to move on to recommendations we have for you, starting with cash management. Our first recommendation is that you establish a household budget that aligns with our recommended cash flow statement that you can find in the executive summary portion of the comprehensive financial plan. In terms of budgeting software, we recommend EveryDollar as it has a very user-friendly interface, and you can start with a free trial that will allow you to familiarize yourself with the software before committing. Next, we recommend Paul transfers $50,000 from his current savings account held at Bank of America into a Marcus by Goldman Sachs high yield savings account. This will increase his annual yield from 1.2% up to approximately 3.5%. We see no reason for you to leave this extra interest on the table. Next, we recommend Amy continues contributions to her 403(b) account as she is currently doing. And lastly, we recommend allocating the new surplus you will have from the recommended cash flow statements to fund $16,200 annually into your brokerage account for retirement, $264 annually into Tammy's 529 plan, and cover all additional insurance premiums we recommend in the risk management segment. Now on to education planning for Tammy. First things first, you need to fill out the beneficiary change form, which you can find at ny529advisor.com, in order to transfer the beneficiary titling from Charles to Tammy. This will enable Tammy to use these funds for educational expenses at Baylor. Next, we recommend reallocating the 529 into the recommended asset allocation that you can find in the education planning segment of the comprehensive financial plan. After you do those two things, you can begin contributing $22 per month or $264 annually into the 529 plan in order to fund 33% of Tammy's education at Baylor. We understand that you wanted to fund 80% of her total education expenses at Baylor, but given your current financial situation, we do not believe this is the best move for your future. Now we can move on to our risk management recommendations. We understand that there are a lot of words on this slide, but we believed it was critical to paint a complete picture of all insurance policies we are recommending, as well as their benefit amounts and their monthly or annual premiums. So let's dive right into it. Amy, we recommend that through the Hartford and Texas A&M's Care Plan, you purchase the maximum amount of optional life insurance, which is $708,000 currently, based on 6 times your annual salary. Next, we recommend you acquire the maximum optional family accidental death and dismemberment policy, which will cover both you and Paul, with benefit amounts falling at $800,000 for Amy and $480,000 for Paul in the event of a covered accidental death. Lastly, we recommend you acquire the maximum dependent life insurance policy for Paul with a death benefit of $200,000. These policies have a monthly premium of $142, $19, and $46 respectively. Next, Amy, we recommend that you acquire a family vision insurance plan through Texas A&M's Care Plan. The monthly premium for this insurance is $24. Next, we recommend that both Amy and Paul acquire a 10-year term life insurance policy through Pacific Life Insurance Company. Amy needs additional death benefit amount of $250,000, while Paul needs an additional death benefit amount of $500,000 to reach our estimated needs. We expect the annual premium for Amy to be around $244 and the annual premium for Paul to be approximately $190. Next, we recommend that Paul acquires long-term disability insurance with a monthly benefit amount of $4,750. This provides roughly 60% of current income replacement, which is sufficient based on financial planning standards, but would obviously require adjustments to your goals if this were to happen. We expect the monthly premium to be approximately $190 for this policy. Now, for both Paul and Amy, we recommend you acquire long-term insurance with a monthly benefit amount of $5,500 for each of you. We expect the monthly premium to be about $150 for Amy and $200 for Paul. Lastly, for your consideration, on your auto insurance policy, you could include replacement assistance due to your desire to purchase new cars somewhat frequently. You could increase your personal injury protection to better protect you and your family members, and you could increase your property damage liability. Other than that, the insurance policy seems sufficient. Before diving into our investment planning recommendations, we would like you to note that the recommendations on this slide are generalized. The reason for this being we could not put our entire trade sheet onto a PowerPoint in a way that looked presentable. If you would like to see each trade we are recommending you execute, then you can refer to the implementation portion of the investment planning segment in your comprehensive financial plan. With that said, let's dive into these recommendations. First, we recommend Amy sells all holdings in her 403b account and allocates them to our recommended holdings. Next, we recommend making the minor adjustments to your 529 plan in order to reach the 62.5% stock and 37.5% bond allocation. Next, we would like you to roll over Amy's current 401k account over to Charles Schwab and grant Drive Wealth Management and Tax Advice LLP advisor trading authority so that we can manage the investments in your account. Simultaneously, we ask that Paul rolls over his brokerage account, Roth IRA account, and inherited IRA account to Charles Schwab and do the exact same thing, granting us trading authority so we can manage the investments in those accounts and reach our desired asset allocation for you. Now that we've discussed the financial areas with the most immediate impact on your financial situation, we can now begin looking towards the future, starting with retirement planning. We would like to start this off by commending you for your excellent job and due diligence in saving up money for a successful retirement. With that said, you may not get the warm and fuzzies from this segment because we are recommending you reducing certain goals that you have set for yourself. But at the end of the day, having a successful retirement is more important than anything else. And that is our job to help you accomplish. So, first things first, reallocating your portfolio to the recommended asset allocation has already been discussed in the investment planning segment, but we believed it was critical to bring up again. Next, we recommend Amy and Paul work an additional 2 years, retiring in 2039. Reduce annual retirement living expenses from $142,000 annually to $110,000 annually. Fund Tammy's college via the 1/3 model rather than funding 80% of it using the 529 plan. Reduce retirement travel expenses from $25,000 each year to $10,000 each year. Reduce retirement anniversary celebrations from $10,500 each year to $5,000 each year. Keep your current house for retirement rather than purchasing a new home. Amy and Paul both purchase a new car every 7 years rather than their current 4 and 3 years, and include an extended warranty so that the majority of your problems will be covered throughout that time period. We also recommend reducing your end-of-life church gift from $500,000 to $250,000, which can be changed, for example, bequest to Charles and Tammy or the end-of-life charitable gift. So this is really subject to change in whichever way you would like to do that. Next, eliminate providing family care each year. This is a significant expense that we just do not believe is in your best interest for retirement. And lastly, invest an additional $16,200 each year for retirement into your brokerage account, like we discussed in the cash flow segment. Our next segment is tax planning, and it is critical for you to note that myself nor any associates at Dry Wealth Management and Tax Advice LLP are currently CPAs, and therefore we cannot give legal tax advice. Therefore, we recommend you engage a licensed CPA to review the following recommendations we have for you, and we can provide a referral if you would like that. First, you need to review potential 2025 tax return errors. We identified possible errors on the QBI deduction calculation as well as your total tax liability. Next, we recommend electing itemized deductions over the standard deduction to reduce taxable income by approximately $3,000 to $4,000 based on our calculations. We also recommend planning how you will pay for the additional taxes resulting from the sale of EA stock in the brokerage account to align with our asset allocation method, such as redirecting the additional $16,200 of investments into the brokerage account that first year into a separate account to help pay for the tax liability. You also need to research if you have any prior capital losses to help offset the EA capital gains. Plan for tax impact of fully liquidating Paul's inherited IRA by 12/31/2035. Evaluate opening a donor-advised fund to offset income during those IRA liquidation years. Look at the benefits of funding a Roth retirement account in the years you're eligible to do so, which should be the 4 years prior to your retirement. And finally, if Paul starts a business, determine the optimal entity structure, such as an S Corp or an LLC, based on income projections you generate. The last segment we have to discuss is the estate plan. The first four items that we are recommending you can do yourself, such as adding beneficiary designations to all retirement accounts, which you can do by simply logging on to your account online or calling the firm that holds your account. Next, add payable on death designations to your checking account, savings account, and Marcus high yield savings account once set up by calling them as well or going into the bank if you prefer that method. And next, you can add a transfer on death designation to Paul's brokerage account. All of these designations allow these accounts to entirely avoid probate and will allow the transfer of assets to be far more efficient. Next, we recommend engaging an estate attorney for the following. First, draft and complete a new will and testament that is current. After completing it, review it every 5 years or any time a major life event occurs. Also, you need to draft and complete a new durable power of attorney. While this isn't necessarily required, your DPOA is very old at this point, and therefore banks and institutions are more hesitant to accept it. You also need to draft and complete a medical power of attorney that includes a directive to physicians and a declaration of guardian to ensure you're protected in the event you become incapacitated. And finally, we recommend establishing a revocable living trust that you can move your house and vehicles into, and you'll need to designate trustees and beneficiaries for that trust. Based on all of the recommendations we have provided in the segments above, this is your revised goals list. Each change is highlighted in red from the current goals list you saw at the beginning of this presentation. And for the sake of time, we will only cover the items that are adjusted. First, the retirement living expenses being adjusted from $142,000 a year down to $110,000 a year. Next, college for Tammy being significantly reduced from funding over $70,000 worth of education each year down to only $264 in actual contributions you will be making. Next, reducing travel and retirement expenses from $25,000 to $10,000, which will still give you enough funds to enjoy a great trip to Europe or multiple smaller trips throughout the country. We also recommend reducing anniversary celebration gifts from $10,500 down to $5,000. Change Paul's car upgrade to every 7 years rather than every 3, and no longer purchase a new retirement home. Next, reduce providing health care for family from $40,000 to 0. The new mortgage is no longer on the table if you don't purchase the new home. And once again, change Amy's car upgrade to every 7 years rather than every 4 years. Lastly, reduce the end-of-life church gift from $500,000 to $250,000. We understand that these are significant changes, and we would love to hear any questions, thoughts, or concerns you have about it, as well as potential goals that you would like to adjust rather than the ones we are recommending. And we can go in to the software, mess around with it, and see what results we get. That wraps up all that we have for you today regarding the executive summary of your financial plan. And we just want to thank you both so much for giving us the opportunity to serve you and watch you as you reach your financial goals. Please let us know if you have any questions, thoughts, concerns that you think that we could answer or you would like for us to address or research further.